Donald Trump is weakening the US dollar, but how dangerous is this for European investors? I've seen some big currency swings over the 17 years of my professional career, including my time on Wall Street and the years I spent as the CEO of a European investment company. In this video, I will show you how a weaker US dollar can hurt European investors. I will demonstrate the easiest way to protect against this, and then I will explain when that could be a bad idea. But first, what does it mean for the dollar to get weaker? Well, if you as a European take a trip to see the legendary Carhenge of Nebraska, you will need to buy some dollars to spend on your trip. Now, if the dollar gets weaker against other currencies, then €1 or pound or Swiss franc will buy you more dollars than before. So you're going to have a great time traveling to America, but it's not so great for European investors who hold American stocks, as we'll see in a minute. Now, before we get to that though, I need to be clear about one important thing. We don't know for sure that the US dollar will get weaker over the next 5 or 10 years. Sure, Trump wants a weaker dollar, but he also wanted to end the Ukraine war in one day, and look at how that's going. Trump could succeed, but controlling exchange rates long term is quite difficult. President Bush said repeatedly that he wanted a strong dollar, the opposite of Trump. But over Bush's 8 years in office, the dollar lost 30% of its value against the euro. That said, this same example does show that big currency swings can happen, and it can be bad news for European investors. To see why, let's assume that you bought $10,000 worth of Coca-Cola stock back in April 2000. At that time, $1 could buy around 1.1 euros. So your investment cost you $10,000 times 1.1, which is 11,000 euros. And then you sold the stock 10 years later in April 2010. Over these 10 years, the stock price went up quite a bit, and you also got some dividends. So the final value of your $10,000 investment was $14,000. But in 2010, $1 could only buy 75 euro cents. So in euros, your final investment value was 10.5 thousand euros. You, as a European, would have invested 11,000 euros up front, and 10 years later, you received only 10.5 thousand euros. All because the dollar got weaker over time. And really, this happens because we Europeans, we love getting a free lunch. You see, according to Nobel Prize winner Harry Markowitz, the only free lunch in investing is diversification. If you want better long-term results and lower risk, you should invest in many different countries. So we Europeans invest globally. And today, over 60% of the global stock market is American stocks. If the American dollar gets weaker, for example, if Trump crushes its value on purpose, then our investments lose value as well. Now, of course, it's not quite that simple. If you make regular investments every month, then a weaker dollar means that you can buy US stocks at a cheaper price. The same amount of euros or pounds will buy you more Coca-Cola shares. Plus, Coca-Cola makes a lot of its money globally, and when those global profits get converted to dollars, they are going to be worth more. And in many cases, if the dollar falls against the euro for a long time, this tends to happen when Europe has lower inflation than America, meaning that the euro can keep more purchasing power. So the long-term impact of a falling dollar on European investors is quite complex, but in the short term, a falling dollar definitely means worse results in our brokerage accounts. Well, what if there was an almost magical kind of investment which could protect you from this problem, so that if American stocks go up 10% in dollar terms, your portfolio also goes up 10% in euros or pounds or Swiss francs? Well, the good news is this investment exists, and you don't have to be Harry Potter to buy it. And to understand how this works, let's take a step back. Many European investors invest in American stocks using ETFs and index funds. These are investment funds which allow you to buy hundreds of different stocks with just a few clicks. They have very low costs, and they get excellent long-term results. Now, the most popular American ETFs available in Europe, like this one, the iShares Core S&P 500 UCITS ETF, these are fully exposed to currency risk. But there's also a version of these ETFs which removes currency risk. These are so-called currency hedged ETFs. For example, here is the iShares S&P 500 Euro Hedged UCITS ETF. For this ETF, the currency risk between US dollars and euros has been hedged away. At least in theory, when the S&P 500 goes up 10% in dollar terms, this fund should also go up 10% in euro terms. Now, in reality, there are always some complications. For one, hedging doesn't work perfectly. For another, hedging costs money. And as a third concern, you get what is called the hedged return. Okay, so this is an extra return based on the difference in interest rates in different currencies. Basically, if average short-term interest rates in dollars are 1% higher than in euros, then you will have to pay 1% per year extra to remove currency risk from your dollar investments. But all these technical complications aside, if your main goal is to remove currency risk, then a currency hedged ETF will do that. You will not have to worry about Trump making the US dollar weaker. And in a moment, I will show you exactly how to find these currency hedged ETFs. Plus, I'll explain how to avoid the single most common mistake that people make with these funds. But first, here's an important warning. Most investment experts don't actually recommend using currency hedged funds for stock investing. And it's because we've been hyper-focused on just one scenario, the dollar getting weaker. But if you look at historical data, exchange rates go up and down all the time. Predicting which it will be over the next few days or months can be just as hard as predicting a coin flip. In the Credit Suisse Global Investment Yearbook for 2012, the famous professors Dimson, Marsh, and Staunted pointed out that, from a profit perspective, currency hedging is a zero-sum game. If you hedge and you are better off, then there's somebody else who's hedging, maybe in America, who is worse off. In some periods, even some decades, you as a European investor might get better results when you hedge. In other decades, you will get worse results when you hedge. And there is no sure way to predict which is going to be better over the next 5 or 10 years. Over the really long term, it will probably not even make a big difference whether you hedge or not. And to understand why, you should think of the stock market as an experienced mountaineer who's climbing a mountain. There are some hills, there are some valleys, some ups and some downs, but over time, the stock market climbs steadily upwards. But by comparison, exchange rates are more like a confused, drunk tourist who goes up the mountainside a bit, then gets lost and wanders back down, and then goes back up and back down, and usually doesn't get very far. For example, the euro as a currency was instituted in January 1999. On the 4th of January, the first day of trading, the euro-dollar exchange rate was 1.18. So let's check what the exchange rate is right now as I'm filming this. It is 1.1486. Basically, just a few percentage points different. Over the past 25 years, the exchange rate has gone up and down and up again, and it kind of ended up in the same place as in the beginning. Or you can look at this chart from the St. Louis Fed in the US, which shows the trade-weighted US dollar index. So this basically, to kind of simplify it, indicates the foreign exchange value of the US dollar against other currencies. Between January 1973 and January 2020, which was the data set that we have, the dollar lost around 15% of its value by this measure. Okay, so there was a 15% difference on average in currency exchange rates over 50 years. And sure, that would be a negative drag on your portfolio as a foreign investor in US stocks. But let's take a look at what stocks did over the same period. Okay, the total return of the S&P 500 between 1973 and 2020 was 10,490%. Okay, so currency fluctuations gave you minus 15%. The growing stock market gave you 10,500%. All right, over the really long term, movements in exchange rates have been quite insignificant compared to stock returns. And whether you hedged or not would not have made such a big difference to the typical investor. Now, does that mean that nobody should hedge currency risk? Well, not at all. When Professors Dempson, Marsh, and Staunton said that hedging doesn't improve your expected profits from investing, they also noted that hedging can reduce your risk, specifically the volatility of your portfolio, so how much it swings up and down. And this risk reduction can be particularly helpful in two cases. First, when you are making short-term investments. So if you plan to sell your investments in a few years, then obviously you don't want a sudden drop in exchange rates to mess up your plans. But of course, in that case, you will probably not be investing everything in stocks, right? Because stocks are not really a short-term investment. And this brings me to the second case in which hedging makes sense, and that is when you buy low-risk investments like bonds. Now, when you look at it at a big picture level, exchange rates could be called moderately volatile. Okay, they swing up and down much less than stock prices. So that means having different currencies in your stock portfolio is usually not a big problem for risk. But they swing up and down more than bond prices, especially when we look at really safe investment-grade bonds with short or intermediate maturities. Okay. Investors usually buy bonds to reduce the risk level in their portfolio. For example, US government bonds are considered to be a really safe place to park your cash. But if you live in the Eurozone and you buy a US Treasury ETF, you're not actually getting a safe investment because the dollar-euro exchange rate will make your portfolio bounce up and down quite dramatically. So in light of that, most experts recommend hedging your currency risk when buying foreign bonds. And this is really easy to do. Just buy a currency-hedged bond ETF. Now, here's an important note that you absolutely should not skip if you're thinking about investing in currency-hedged ETFs. If you want to find a hedged ETF, it needs to say hedged in the name or in the description. Just because the ETF name says Euro, like the BNP Paribas Easy S&P 500 UCITS ETF Euro, does not mean that it's hedged, okay? The easiest way to find actual currency hedged ETFs is by using justetf.com. Okay, so just go to justetf.com, look at the ETF screener, scroll down on the left side to currency hedge, and select your currency. So for example, if I lived in Switzerland, I would click on CHF hedged, or if I lived in the UK, I would click on GBP hedged, and so forth. And that will give you a selection of ETFs hedged to your home currency. Okay, so I hope that helps. And actually, choosing the optimal ETFs for your portfolio here in Europe can be a little bit tricky. You have to take into account not just the currency, but also your age, your goals, your risk tolerance, and the tax rules in your country. So if you want to see how I select ETFs for my personal portfolio, I've got a training that could be helpful. Just follow the first link in the video description.